Hello and welcome to LAT's Weekly Market Insights. This week, markets have been dominated by the eagerly anticipated Fed rate decision, and that decision didn't disappoint. We have seen volatility broad spectrum across multiple asset classes, the commodities, the FX sector majors being moved predominantly by broad-based dollar strength, and the indice markets taking a leg lower. Despite this, we have seen some divergence between the indice markets as the tech sector has boosted and had a rally to all-time highs. As we come down to the charts, we can start to see some of the volatility through these asset classes, which we'll have a look in a bit more detail in just a minute. The Federal Reserve now has for months been wary of signalling that an end to its pandemic-induced ultra-loose monetary regime was in sight. However, on Wednesday, we suddenly saw that wind down hone into sight. The Federal Reserve officials expect to start raising interest rates as a year earlier than previously expected, pulling those forward with 2 rate hikes into 2023 instead of 2024. Now, as we bring up the dot plots, we can see that shift and move in towards 2023. This back from the FOMC members' date from back in March. And we can see the majority of the committee here sitting with an unchanged rates in 2023, looking at longer term into 2024. When we compare that with the new dot plots that have come through from this week's meeting, we can see that transition, a move away from the unchanged, and more people pushing towards, and committee members pushing towards, a rate hike into 2023. But the economic projections of the US central bank officials reveal that most now expect it not only to be 1 rate hike, but in fact a 2-notch interest rate rise in 2023. Now, as we previously stated, this is a year earlier than expected and was seen as being incredibly hawkish. This has been driven by positive data coming out of the US. The unemployment rate is expected to fall to 3.8% by the end of next year from 5.8% in May. Now, despite this, during the press conference, Powell did try to stamp out notions of rapidly accelerating timeline towards monetary tightening, saying the dot plot needed to be taken with a grain of salt. There were still risks posed by the virus, and policy changes would happen step by step. Despite this shift in sentiment, this shift in tone did then go forward and reflect into the markets. And we can see this here. The commodity sector has been hit hard. Broadly, the commodities priced against the dollar, and as we have a look here towards copper, we can see longer term trends being taken out. There is the major uptrend that was broken, the crossover of our moving averages, and the break through that S1 monthly pivot point and strong support region coming in through here. It wasn't only copper that felt the pain. Gold also took a hit, again predominantly provoked by that broad dollar strength. It was a clean move again, trend lines very similar to copper having been broken, a move below the moving averages, and then the break of key support levels. And again, the warning signs were here pre this release, as we once failed to make this high, a new higher high, that lower high suggesting that loss of momentum, the follow through then coming off the back of this data. Since then, moving back like many of these charts now, they are finding technical support levels and taking a breather as we run in towards the end of the week. So the commodity sector hit hard by this news, and as we said, partly driven by that broad-based dollar strength, and we can see that when we come through to euro dollar, it's been an aggressive accelerated move lower. But again, the warning signs were there, the technicals are there. We looked at this last week in our insights video, this uptrend which had transitioned now into a downtrend, and we saw a break and a close through the previous lows, suggesting this had further downside. Of course, the hawkish Fed acting as the catalyst here, but in line with a technical downtrend. The one chart that's actually seen a little bit of whipsaw, we've seen an aggressive move up and then back down, has been dollar yen. Now, on the initial announcement, nothing was stopping that dollar strength, that broad move into the dollar, and that pushed dollar yen considerably higher. Since then, we have seen that flight to safety. We've seen a risk-off tone in the markets. We've seen indices step back slightly, and the Japanese yen reverting back to its usual safe haven status, and gaining a little bit of strength. We're also seeing this yen strength follow through for the sterling pairs at the moment, as cable continues to move lower, and sterling yen off the back of the weaker than expected retail sales data that was released today. So that's the commodities and the FX sector. Now let's have a look at the indice markets, and we'll start with the US indices, and we'll have a look at that benchmark of the Dow Jones. And it's a very similar story to euro dollar. Okay, this trend had transitioned from uptrend into downtrend, posting lower highs, lower lows, finding strong resistance from these moving averages before ultimately the trigger from the Fed prompted a break through this key support level. Now what's interesting with this support level breaking is again the signs were there. Selling pressure was building, consistent lower highs before ultimately finding a catalyst to push it lower. And we're still trading lower here towards the end of the week, and we're not giving back any of those or gaining back any of the losses that we've seen over the past couple of sessions. The one market that's probably not been too affected by this has actually been the DAX. There was a slight marginal step lower, these European indices not reacting hugely towards this US data. And we are starting to see a move back from the top of this channel and a potential failure to make a new high in the early hours of this morning and late yesterday afternoon. And some slight weakness coming through. But broadly, the DAX remains unchanged off the back of this data. As we're looking towards other news within the markets, Joe Biden met with Vladimir Putin in Geneva this week. Now, Biden warned Putin of fallout with Alexei Navalny. If he was to die, the US warned that there would be devastating consequences if this Russian opposition activist died in prison. In the first face-to-face meeting of the pair as leaders, they agreed to begin bilateral talks on preventing cyber attacks, arms control, restoring their respective ambassadors, and exploring potential prisoner exchanges. So that's been the story of the week this week. Dramatic moves in the market. Those of you that managed to trade it and take some profits in the markets, well done this week. If you didn't manage to capitalize on these gains, that is absolutely no problem. Try not today for the rest of the day to chase those losses, to make up for lost ground. Be content to sit, see where these markets are next week, and attack it with a fresh pair of eyes. For now, we continue with this broad dollar strength and risk-off mood. Please do join us same time next week for another Weekly Market Insights.